Hello, and welcome to Virtual Investor Conferences. On behalf of OTC Markets, we're very pleased you joined us for our annual OTCQX Best 50 Conference. Our next live presentation is from First Acceptance. Please note you can submit questions for the presenters in the box to the left of the slides. And you can also view a company's availability for one-on-one meetings by clicking Book a Meeting in the top toolbar. At this point, I'm very pleased to welcome Ken Russell. He's the President and Chief Executive Officer of First Acceptance Corp, which trades on the OTCQX Best Market under the symbol FACO. Welcome, Ken.
Thank you, John. As John said, I'm the President and Chief Executive Officer of First Acceptance. We're a non-standard insurance carrier. We're based in Nashville, Tennessee. And with me and joining me today is our Chief Financial Officer, Brian Dickman. And later in our program, our Investor Relations Officer, Mike Bodell, will be participating in our Q&A session. I think I'll start out with giving you a little bit of background and some history of our company. First Acceptance evolved from a family-owned insurance agency. It was started in Nashville back in 1970. And it operated as an individual agency for about 25 years when in 1996, it formed its own underwriting insurance company that's to sell non-standard auto insurance policies through its company-owned retail stores. At that time, all the stores were in Tennessee. Now, I might mention that non-standard auto insurance policies is not an everyday term. So to give you a little definition of that, these are policies have minimum limits. They're for more or less an economic level of insurance purchasers who don't have the wherewithal to necessarily buy a full year, and so they do it month to month. And as I mentioned, they have a little bit smaller limits. But this operation over the next 8 years began to develop a retail network, and they expanded to 7 states. And in 2004, a significant transaction took place. The company merged with a public company. It was a non-operating public company, and it received a significant capital infusion from a private equity investor. In addition, the company issued $40 million in trust preferred debentures that also supported operations. So over the next several years with this additional capital, the retail network was continued to expand to additional 8 states. Many of the expansions were done through acquisitions in Texas, Illinois, California, and Arizona. And at that time, the retail network grew to over 400 retail outlets, with 15 states, licensed states being in that network. Now, the original founders that I mentioned that started the company back in 1970 decided to depart the company back in 2011, and they sold their interest, which was about 1/3 of the company, to both the private equity investor, and the company bought back a portion of the shares as treasury stock. The result of these transactions put the private equity investor into a controlling shareholder's position. However, while the company was now under control of one shareholder, it continued to be listed on the New York Stock Exchange until 2018, when the board of directors elected to delist from the New York Stock Exchange and list on the OTCQX. Let me tell you a little bit about the business model the company has been dealing with over the last several years. Up to 2018, the underwriting and issuing of non-standard policies were distributed primarily through the captive retail outlets, and it was under the branded name of Acceptance Insurance. If any of you have happened to see a little green car that winks at you, that's Acceptance Insurance. Along the way, the distribution was also done through a website as well as a call center, and those channels grew to about 15% of the total policies sold. The retail outlets sold only the first acceptance policies, plus other ancillary products such as roadside assistance. But beginning in 2018, the retail stores began to offer and sell other third-party underwritten insurance products like homeowners, motorcycle, and commercial. And these were done on a commission basis. Additionally, in certain markets, other third-party auto insurance policies were offered and sold through the retail network. Beginning in 2021, the company began to ramp up its distribution through independent agencies. Previous to this ramp up, this channel was a very minimal amount of the distribution. As part of the move to independent agents, a partnership with an InsurTech sales company was established, and this InsurTech company exclusively sells first acceptance policies strictly through the internet. In December of 2023, the company made a significant strategic move, and it sold its entire retail network. At that time, right around 300 retail stores. We also sold the brand name Acceptance Insurance, its website, and all related assets to a subsidiary of Alliance Insurance Company. This transaction resulted in the company moving to a 100% independent agent distribution. And I'll talk a little bit more about what that agency looks like now after the sale of the retail part of the business. The new distribution model of sole independent agencies is more typical of the auto insurance industry, and it eliminates the need to manage retail and relieves us of its fixed cost burden. This has always been a real challenge in managing the retail side of our business. And people ask us after we sold the retail, after losing control of the distribution of the sales of the captive, doesn't that give you some concern? And the answer is not necessarily, because having independent agencies rather than captive are much more flexible when we want to change markets. If we wanted to change a market with the stores, we had brick and mortar agencies that we would have a significant capital, need to make any kind of change. Where the independent agents, we can easily appoint or terminate just through contractual agreements. Managing and changing agencies based on performance, loss ratio metrics, and adverse selection are so much easier under this new model. Currently, we have three primary independent agent distribution channels. The first is what I would call a traditional independent agency. These are sometimes referred to as mom and pop, and maybe even larger than that, but each individual agency is separate. We have the InsurTech partnership that I had mentioned earlier, and then we have the Alliant Retail Network, which included all the stores that we sold in December of 2023. The traditional independent agencies currently appointed are in 12 of our 15 licensed states. There's approximately over 500 agency locations with over 700 individual selling agents appointed. The company has business development advisors assigned to each one of these independent agencies who manage our relationships. The retail agencies of Alliant affiliates, I mentioned that we had sold in December 23. There are approximately 850 stores and over 1,300 selling agents. While we only sold them 300, they have appointed others stores under other agency names that sell our product in their network. At the date of sale, Alliant and its affiliates entered into a production agreement with First Acceptance to write a minimum and a maximum level of policies by state for the next 3 years. Our InsurTech partner is also an independent agent, but it exclusively sells online through a web interface. One of their key attractions is they're in a position to offer smaller down payments for customers, and that attracts a lot of the non-standard customers to sign up online. Currently, they're selling only what we call liability-only policies, not to include the property damage and collision and comp type coverages. To tell you a little bit about leadership, I've been the president CEO, started out in 2016 when I was asked by the controlling shareholder, who I had worked for as a senior advisor, to take over in this position. I'd been a director of the company since 2014, and over the next few years, I was able to fill all key executive positions with experienced individuals having significant insurance expertise, which also included a lot of non-standard experience. One of these is Brian Dickman, who will be speaking to you in a couple of minutes. Brian joined the company back in 2019. He's been an instrumental factor in reforming our insurance operations, especially subsequent to the sale of the retail distribution. I gave myself a note. If I had a moment, I'd tell you about a couple of the more recent challenges. And I think if you've been around insurance companies, you know that they're constantly running into some type of an industry challenge. But the first one, I think it wasn't just wasn't just insurance, it was all companies, and that was the COVID problem. Revenue obviously declined during COVID, but for an auto insurance company, it was really benefited through favorable loss experience because nobody was allowed to get out and drive and run into each other. So that was a bad situation that turned out not so bad. And then following the COVID pandemic, because of the increase in used car prices and delays in supply chain, physical damage severity began to rise. And this continued on into 2022 before improvements were able to be realized. Fortunately, our company's product group were able to react and receive regulatory approval to increase premium prices. And I know everyone complains about either their house insurance or the car insurance, but what drives that is always losses. So it's not just the insurance companies trying to get rich. So we were able to turn the corner with all these severity issues back in 20 and 21, and beginning in 23, we started being profitable and have been profitable ever since. So these are the comments that I wanted to start our session off on. I'm going to let Brian get into more of the operational and financial side of our business. With that, I'll turn it over to Brian.
The company has gone through a number of changes over the last handful of years. And just a little bit of information, insurance is a regulated business. Doing business in each state, requires approval by the states. There's no federal regulatory oversight. And each underwriting carrier is required to maintain sufficient capital and adequacy. And we are well within those requirements, especially the transaction really injected strong capital into us to allow us to grow the business. On the slide, when we talk about an insurance company and how we really look at from a margin perspective and how we make money, so we look at it at a combined ratio. So included in that is the cost of claims, your losses, and these are all percentages of earned premium. You have your loss expense. LAE is the cost of how you handle the claims, getting them closed, et cetera, it's staffing. And then you have underwriting expenses, and we report those net of fees that we collect in there. That gives you your combined ratio. Basically saying for every $100 we collect, we make $7 when we have, when you include investment income, we have an operating ratio of 93% for 2024. So a couple of the key things that have really changed over the last, with that transaction and moving, as Ken mentioned, as we previously were had the stores, and from a retail environment, there was a big change. We went from an 80% fixed cost structure, having the stores, the brick and mortar, and the agents, to now, after the transaction and being just running through independent agents, we're 80% variable. It allows us to be in a much better position to ebb and flow with, as anyone follows the insurance industry, it is very cyclical. As Ken touched on, there were changes through COVID. It was good early on for insurance companies. Then in 22, you saw the impact of supply chain impacts on pricing, used car values going up, affected the claims. So a lot of times your insurance companies are really trying to react to changes that are coming through the industry. Having that variable cost structure allows us to adapt and flow that we didn't have. We weren't in that position before with the when we owned the agencies. The other important factor, so when we went back in 2021, 22, as we started to bring on the independent agents, had the InsurTech companies come on, we were starting to grow premium. We really wanted to grow our policies in force. The other part of that is, as we take the premiums that we collect from our borrowers, we're able to invest that. So the two big things happened after the transaction and going to the company that we can exist now, changing from a fixed to variable expenses and our net investment income. Our portfolio has grown materially now that being just an independent carrier or an agency, as well as growing those premiums, the premium going up, we can invest those. In the past, we had a fairly small portfolio. Our net investment income wasn't a real material amount. That is different now. As a lot of insurance companies know, when you have ebbs and flows, and if you write at 100 combined ratio, meaning you're paying out dollar for dollar or that you're collecting in, your profit comes from your investment income. That puts us in a much more stable position from an earnings perspective. We can adapt and handle through some of those times where your severity, your cost of claims go up. If your frequency, how often a claim comes in, goes up, we're in a much better position to handle those as a company and remain profitable. The other part I wanted to show is just, so we have our, as Ken mentioned, we have our distribution channels through the partnership with Alliant. We have our InsurTech and then the traditional agencies. We currently write in 11 states. We have licenses in another 7 or 8 states currently that we can expand into. And that's another key strategic area that we're looking at, is how do we not only look at adding additional distribution, but adding additional states into, so improve our concentration risk. As Ken mentioned, being in the independent agent versus having the brick and mortar now from a financial perspective allows us to ebb and flow as we see certain areas, because certain areas get affected by different trends than others. It's not always, and it's rarely a national across every footprint. Now, without having the stores, we can look at specific areas and be much more targeted as we make adjustments to any underwriting restrictions. If we have to take rate increases, we can do those in the areas where we're really seeing it and maintain other areas that are having favorable results. Finally, just wanted to touch on, one of the things that we've continued to see, just as a company, again, making that big change in 2023 with the sale of the agency. You can see the trend of our tangible book value versus the stock price. We had some goodwill on our financials back from previous acquisitions that we were able to write off through the transaction, and we consistently are running $1 discount from the tangible book value from where the stock's trading at. So we can, our goal is just to continue to add value, keep driving that up, and then create more visibility to potential investors. So at this time, we'll move on to the Q&A section.
Okay, can you hear me?
Yes.
All right, my name is Mike Bodale. Ken introduced me earlier. I coordinate the investor relations for the company. And we've got a couple of good questions here that I'm gonna pose to Ken and Brian. The first one asks whether we have any direct retail sales resources now, or is it exclusively through independent agents?
Sale of the retail network, all our retail resources went with the sale. And so if we had support, people like in marketing and all that supported the retail, they all went with the, either went with the sale or are no longer with the company, since we're not into that operation anymore. So we currently have no retail resources.
Okay. The next question is, can we break down the percentage of our revenues by product line, auto, renters, and life? And the second part of that question is, do we have success in bundling policies?
We do. 98% of our revenue is driven by our auto policies. Again, through the sale of the agencies. The agencies, they took that. They have additional products. We, as the carrier, really just write with the auto product and a few of the add-ons, but it's 98% through auto.
Okay. The next question. We had talked about how our operations stabilized in 2023, and the question is, why did we have unfavorable prior period loss development so large in 2024?
So in 2024, really a lot of that prior development was through our InsurTech product, which is a very new market and industry. The positive part of that is that relationship has an adjustment in the commission structure so that we're able to claw back commission paid that's connected to those loss trends. So even though we did report the unfavorable prior period loss, we're able to claw back almost the equivalent from a commission perspective. So for us, and from a financial perspective, it was a zero impact to the bottom line.
Okay. Next question. Any plans to operate in the additional 11 states where we are licensed?
Well, we do have plans. In the past, with the retail structure, we were limited in doing much state expansion because it costs so much to put a store in any particular market. Now that we're doing 100% independent agents, we can go very easily and appoint traditional independent agents in other states, and we have plans in the very near future to expand into some of those states.
Okay. Next question. Do we expect to receive the additional contingent consideration of $30 million from the sale of the retail insurance agency? And if so, what do we plan to do with that capital?
Brian, go ahead.
Yes, so we do expect to get additional consideration over the next 2 years related to the transaction, and we'll continue to monitor our growth. There's a couple different things we can do with that money. We will look at, as I mentioned before, there's regulatories, there's written premium to surplus that they guide you to maintain. We are well below those. If we have opportunities to really grow premium in a certain area, we'll invest that capital into the insurance company so that we can support that growth. The other things that we can do with it are continue to look at efficiencies through our claims operation and our other operating in our systems, and that to continue to put ourselves in the best position to take advantage of opportunities down the road.
Okay. What trends are we currently seeing in Georgia and Florida as it relates to auto insurance rates?
Well, I mean, in all states, the trend is up. We have not applied for a reduction in rates in the last several years because claims don't slow down, and claims is what drives rates. And well, each state doesn't increase at the same rate, of increase. All states have had only increases over the last several years.
Okay. Can we discuss our reinsurance plans for the future?
Yes, we do, and we currently have a reinsurance agreement in place that, and we use that solely for our InsurTech, but we have that there, and that is another way for us to, an option as we look at potential additional partnerships or other areas or distribution channels for us to grow in, that we can if we decide to leverage that reinsurance to keep our, remove some of the risk off our balance sheet and keep our ratios at the appropriate levels.
What are the growth drivers for the company over the next 3 years?
Those are, so we're looking at increase in distribution channels. We're looking at, we have 3 main ones now. We're looking to add a few more channels to continue to improve the risk on concentration, not only with distribution channels, as asked before, we are looking at additional states to go into within that footprint. We have a different, it's a lot easier for us to do that now. Before with the retail, we'd have to go open up stores, et cetera. With our relationship with the Alliant company, they have a lot of distribution opportunities, even outside the current footprint that we go, that we can partner with them, as well as we can always appoint additional independent agents, smaller agents. So the nice thing now is we can dip our toe into a market, test it, see how does it work, and then decide to really go into it where we weren't in that position in the past.
What key initiatives does the company have to reduce the cost of handling claims, which were noted as at 10.6? And also, is there a goal for this ratio?
Yeah, so we're constantly looking at how we do those. You look at AI opportunities. You look at, one of the things that came on a number of years ago was photo opportunities, using photos to handle claims and at least see the initial cost through there. Again, system processes, how can we better address and get those claims? How can we always look at, can we improve the timing of claims? As anybody knows, as longer a claim holds on, the more expensive it becomes. We're looking to target under the sub 10 is our goal from just the claims percentage.
Well, there's a few questions here, and wondering whether we can elaborate on any plans we have for future stock buybacks or dividends.
All right, Brian, I'll address that. We don't have a stock buyback plan. There's been times where we've had opportunities to buy back stock at a favorable price, and we've done that, but we don't have a program. Dividends, now that our profitability has stabilized, I think that's coming onto the radar. We haven't made any decisions to start that, but if we can continue to grow the revenue or the profitability of the company like we had, I think it's in the foreseeable future a possibility.
Now here's 2 questions that are related. One asks, what would our views be about selling the company to increase shareholder value? And then the corollary to that is, there haven't been any recent transactions in the industry which give any sort of in relationship to what the value of our company might be.
Yeah, well, I would say there's no current plans to sell the company. We're still operating. We're continuing to build our operations and trying to build value. I think you can see from the book value, which we believe is probably a better indicator than what the market value is out on OTC, that we've gone from a tangible book value of the end of 22 of 85 cents to a book value of over $4.40 at the end of 24. So we continue we believe, to build value for shareholders in that. Unfortunately, the market doesn't seem to want to, continue to track. In the past, book value was a pretty good surrogate for market value, but as Brian's chart shows, over the last year or so, it's been a significant discount. Market was a significant discount to book value.
What are the company's primary concerns about partnering with an insurtech business?
So from an insurtech business, I think one of the things you want to watch out, and from my experience looking in the past, is how they handle claims. That can be a tricky business. Now, in our regards, our partnership with that's what we do well. That's what makes First Acceptance extremely strong as a carrier, is our claims processing. So for our partnership, it's more from just them being an agency. I think that's where insurance companies have to be careful. To leverage, and I think it's a great opportunity and a great distribution channel from a selling aspect. But when it comes to how you handle claims, how you process, how you manage and investigate those, et cetera, that's where I think some companies need to be careful, in my opinion, on how much you let some of that drive claims processing. That's a little bit slower to go. But from our perspective, and what makes us confident that we stay in, is really partnering with them from just a distribution and selling perspective, in us always keeping control of processing the claims.
Okay. Brian, here's one I know we kind of asked earlier, sort of a follow-up to that question. And it deals with the loss reserve development. And I sort of understand this, with my accounting background, but maybe I think you could probably explain it. But there's a confusion in looking at our loss development when we talk about what the development was for the quarter and what the development was for the year, and how the numbers don't add up. I think you know what I'm talking about, because it's outside of the different periods. I don't know if you want to elaborate.
So as you move forward on unfavorable developments, so if you're in Q1, your unfavorable development is related to Q4 and all your prior years. But then you get into Q2, you would look at unfavorable development would be anything in the prior years, as well as Q1, especially when it's just related to unfavorable development. The difference being, you want to really look at how it's trending is unfavorable prior year development when it's reported. That's always reporting out to the previous year. So it's kind of an insurance industry standard. It's kind of a moving, you can't really add those up when you're from just an unfavorable development perspective, because the time period that you're looking at is always changing as you're moving forward.
And maybe we could just do this one final question, and I think we've got them pretty well covered. What are we doing to increase shareholder value from a communication standpoint, and how are we bringing in new investors and increasing liquidity? And then also, do we have any thoughts of uplisting to NASDAQ, which would enable the company to get into the Russell index?
Well, we intentionally delisted from the New York Stock Exchange because the controlling interest is with one individual or one individual and family. And therefore, having the listing we saved probably $1.5 million a year in cost. Now, I know that didn't, play well for, the market and liquidity and all, but it is, beneficial to the operations and the value of the company for the shareholders. So that was the primary driver of why we delisted. It wasn't for, any other reason other than cost saves. Oh, right now, I don't think we have a program, Mike, that where we were able to do much as far as communication. This, I guess, is probably our, the best example of at least getting out to our potential investors of what the company's about, but we haven't done a whole lot in that area yet.
I think we've got the questions pretty well covered.
Okay. I'd like to thank everyone for attending our session and learning a little bit about our company. You can probably tell from our presentation we're not experienced at this, but we want to get the word out to everyone to tell you about our company and how excited we are for investing in First Acceptance. Well, thank you all.